I would get statements and reports from all these different mutual fund companies until in the early 1990s, Charles Schwab came up with a program where you can buy and sell no-load mutual funds inside one account with Charles Schwab, the first company to come up with that program. After they developed it, everybody else copied it. Fidelity copied it, everybody else copied it, and now there's a whole bunch of providers that do that. The industry noticed that people, Money Magazine and a lot of the financial publications started to tell people not to buy what they called loaded mutual funds with these big front-end commissions. So what they did, what the industry did, was they created another class of shares for these exact same mutual funds, and they called them B shares. And they dropped the front-end load, so there was no fee to buy the mutual fund, but there's a redemption fee. And you had to tell the consumer at that time that if they held the mutual fund for 4 or 5 years or 6 years or whatever it was, that they wouldn't pay any fees. But internally, what the mutual fund company did was they jacked up the management fees to cover that front-end load. So the broker was still getting paid up front for those sales of those mutual funds, and they created an escrow account that was deducting the fee every year from the mutual fund itself, so you were paying more and your return was less by, say, 0.75%. So instead of paying a 1%, to be a little extreme here, instead of paying a 1% management fee, instead of paying a 5% commission up front and then a 1% management fee, what they did was they had no commission up front, but they charged a 1 3/4% management fee. And then they would drop that redemption fee down every year by a percentage point or so, or whatever, until it disappeared. But they collected all those fees throughout the year. So they built kind of an escrow account inside the mutual fund in order to pay the broker.